Retirement tax planning. How to keep more of your money. When most people think about retirement planning, they focus on the accumulation side, saving enough, investing well, hitting the number they need. What gets far less attention is what happens to that money once they start drawing from it. And here is the part that surprises most people when they actually run the numbers. For many households, the tax paid on retirement income over a 20-year retirement exceeds the total investment fees paid over an entire 40-year working life. The tax bill in retirement is larger than the cost of building the portfolio in the first place. That is not inevitable. It is the result of planning that stops at the accumulation stage and picks up again only when the IRS sends the bill. This video is about the planning that happens in between, the specific decisions made in the first 5 to 10 years of retirement that determine whether you pay the minimum legally required tax on your retirement income or significantly more. And I want to be clear about something before we go further. These are not aggressive strategies. They are not gray areas. They are the straightforward, legal, universally available tools that the tax code provides to retirees, and that most retirees simply never use. The starting point for retirement tax planning is understanding your tax position more precisely than most people ever bother to. In any given year of retirement, your federal income tax bill is determined by the sum of your taxable income from all sources, minus your deductions, compared to the federal tax brackets. That sum, your total taxable income, is the single number you are trying to manage. For most retirees, taxable income comes from 4 places: withdrawals from traditional 401ks and individual retirement accounts, all of which are ordinary income. Social Security income, up to 85% of which can be taxable depending on your provisional income level. Any pension income, and income from taxable investment accounts, dividends, interest, and capital gains realized during the year. The deductions available to most retirees are straightforward, primarily the standard deduction, which is $32,200 for married filing jointly in 2026, with an additional $1,750 per person age 65 or older. That means a married couple both age 65 or above have a standard deduction of $35,500 before any income becomes taxable. Understanding your number, total expected taxable income minus total deductions, in any given year, tells you exactly where you sit in the bracket structure and how much room you have to manage income either upward or downward before crossing a meaningful threshold. The goal of retirement tax planning is to keep that number as low as possible in high-income years, and to use low-income years deliberately rather than letting them go to waste. The most powerful single concept in retirement tax planning is the idea of intentional income smoothing, deliberately keeping your taxable income within a consistent bracket year after year rather than allowing it to fluctuate unpredictably. Here is why this matters. The federal income tax system is progressive. The more you earn in a given year, the higher the rate on the marginal dollar. A household that earns $80,000 of taxable income every year for 20 years pays far less in total federal income tax than a household with the same total income that earns $150,000 in some years and $30,000 in others. The $150,000 years push a significant amount of income into higher brackets. The $30,000 years leave lower brackets completely unused. In retirement, income smoothing is largely within your control, because you control how much you withdraw from tax-deferred accounts in any given year. In practice, this means 2 things. First, in high-income years, when Social Security is in payment, required minimum distributions are running, and you have other income, keep discretionary 401k withdrawals to the minimum needed for your spending. Do not take extra to fund a renovation or a gift in a year when your bracket is already elevated. Plan for those expenditures in lower-income years instead. Second, in low-income years, particularly in early retirement before Social Security begins, do not simply take the minimum you need to live on and leave the rest of the bracket unused. Draw 401k income up to the ceiling of the 22% bracket, or convert the difference to a Roth individual retirement account. Every dollar extracted at 12 or 22% today is a dollar that cannot arrive later as a forced required minimum distribution at 24 or 32%. Social Security taxation is the element of retirement tax planning that causes the most surprise and the most preventable tax cost. The rules are simple enough. For married couples filing jointly, up to 50% of Social Security becomes taxable once provisional income exceeds $32,000. Up to 85% becomes taxable once provisional income exceeds $44,000. Provisional income is your adjusted gross income plus tax-exempt interest plus half your Social Security benefit. The problem is that most retirees have no idea what their provisional income is until they file their return, by which point it is too late to change it for that year. And the impact of crossing the 85% threshold is not trivial. A couple receiving $36,000 in Social Security who crosses the upper threshold has $30,600 of that Social Security added to their taxable income at their marginal rate. That is an additional tax bill of $3,366 to $7,344, depending on their bracket. The practical management tool is the substitution strategy. In any year when your provisional income is approaching the $44,000 threshold, substitute taxable 401k withdrawals with Roth individual retirement account withdrawals. Roth withdrawals are not included in provisional income. They do not appear in the calculation at all. Shifting even $10,000 to $15,000 from a traditional withdrawal to a Roth withdrawal in the right year can keep significantly more of your Social Security untaxable. This is not complicated maths, but it requires knowing your provisional income number before the year ends, not after, which means tracking it throughout the year rather than only discovering it when preparing taxes in April. Medicare premium management is the third major lever in retirement tax planning, and it is the one that most people never think about until the bill arrives. Medicare Part B and Part D premiums are not fixed for all retirees. They are income tested through the Income-Related Monthly Adjustment Amount Surcharge System. In 2026, the surcharges kick in for individuals with income above $106,000 and for married couples above $212,000, and they step up in tiers at $133,000, $167,000, $200,000, and $500,000 for individuals. Crucially, Medicare uses your income from 2 years prior to set your premiums. A large 401k withdrawal or a large Roth conversion in 2026 affects your Medicare premiums in 2028. The connection is invisible. 2 years separate the decision from the consequence. At the first surcharge tier for a married couple, the additional annual Medicare cost is approximately $1,182 above the standard premium. At higher tiers, it rises sharply. A household that crosses the threshold due to a large one-off withdrawal, a car purchase, a home renovation funded from the 401k and stays above it for 2 years, pays an unnecessary premium of $3,564 or more. The planning response is to model Medicare premiums as part of every significant withdrawal decision. Before making any large 401k withdrawal, check what the total income for that year will be and whether it crosses a Medicare threshold. If it does, consider whether a Roth withdrawal, a taxable brokerage sale, or spreading the withdrawal across 2 years keeps you below the threshold. The tax saving from staying below a Medicare tier is real and immediate. One of the most overlooked retirement tax planning tools is the qualified charitable distribution, and it is available only to people aged 70 and a half or older. A qualified charitable distribution allows you to transfer up to $108,000 per year directly from your individual retirement account to a qualifying charity of your choice. That transfer counts toward your required minimum distribution for the year, meaning it satisfies your minimum withdrawal obligation. But it never enters your taxable income. It does not appear on your tax return as income at all. For retirees who give to charity regularly, this is a straightforward substitution. Instead of taking your required minimum distribution as taxable income and then writing a check to charity, which gives you a deduction only if you itemize, which fewer people do since the standard deduction increased, the qualified charitable distribution removes the income entirely. The charity receives exactly the same amount. You pay no income tax on it, and since it never enters your adjusted gross income, it cannot affect your Social Security taxation thresholds or your Medicare premium calculations. For a retiree in the 22% bracket, taking a $20,000 required minimum distribution annually and giving $15,000 of it to charity, using a qualified charitable distribution, rather than taking the full distribution as income saves approximately $3,300 in federal income tax per year. Over 10 years, that is $33,000. The qualified charitable distribution is, dollar for dollar, one of the most efficient tax moves available to charitable retirees. Yet a significant proportion of people who would benefit from it have never used it and in some cases have never heard of it. Roth conversions sit at the center of every effective retirement tax plan. They are not a one-time event. They are an annual discipline that, executed over 5 to 10 years in the low-income period of early retirement, restructures the entire tax profile of a retirement portfolio. The mechanics are straightforward. You move money from a traditional 401k or individual retirement account, where it would eventually come out as taxable income, to a Roth individual retirement account, where it grows and withdraws completely tax-free. You pay income tax on the converted amount in the year of conversion. In return, you permanently eliminate the tax liability on all future growth of that money and remove it from the required minimum distribution calculation. The key is doing it at the right rate. Converting at 12 or 22% in early retirement, when income is low and bracket capacity is available, is fundamentally different from being forced to take the same money as a required minimum distribution at 24 or 32% in your 70s, combined with Social Security income and Medicare surcharges. For a household converting $50,000 per year at an effective rate of 15% over 6 years, a total of $300,000 converted at a total tax cost of $45,000, and comparing that to the same $300,000 arriving as required minimum distributions at an effective rate of 24%, a tax cost of $72,000. The lifetime saving from the conversion strategy is $27,000 on that one tranche of money alone. When you include the elimination of Social Security taxation and Medicare surcharges that the lower required minimum distribution balance prevents, the total benefit is larger. The Roth Conversion Modeler Inside Retirement Ready US calculates the optimal annual conversion amount for your specific situation, accounting for your current income, your bracket headroom, the Social Security provisional income threshold, and the Medicare tier boundaries. It removes the guesswork and shows the lifetime benefit in concrete terms. Link in the description. Retirement tax planning is not something you do once and then leave on autopilot. It is an annual practice. A review at the start of each tax year that asks the same set of questions and answers them with current numbers. What is my total projected income from all sources this year? Where does that put me in the bracket structure? How much 401k or individual retirement account income can I take at my current marginal rate before crossing the next threshold? Do I have Roth conversion capacity available at a rate I would be comfortable locking in? Does my income this year affect my Medicare premiums 2 years from now? Am I giving to charity in a way that could be structured as a qualified charitable distribution instead of a cash gift? These questions, answered once a year with a full picture of your income, are the practice of retirement tax planning. They are not difficult questions. They require current numbers and an understanding of the thresholds. With the right tools, they take an hour. The households that pay the minimum legally required tax on their retirement income are not doing anything complicated. They are simply asking and answering these questions every year, rather than discovering the answers for the first time when their tax return is filed. Run your own numbers using Retirement Ready US. Link is in the description below. Hit like if this was valuable. Subscribe for more US retirement planning content. I will see you in the next one.